Welcome to a new PE Forum Fireside Chat. We're delighted to welcome Thomas Dani, Managing Partner and Co-founder of RCP Advisors. With over 2 decades of experience in private equity, Tom has been at the forefront of identifying opportunities, building lasting partnerships, and navigating the evolving landscape of alternative investment. RCP Advisors is a firm recognized for its expertise in the lower middle market and for supporting emerging managers who deliver on the long-term value. In this interview, Tom will share his insights on RCP's strategic approach, his perspective on key industry trends, and the lesson of his own journey that continue to drive his leadership and impact in private equity. Tom, thank you so much for taking the time.
No, it's my pleasure. Thanks for having me.
So I want to start by seeing with you why you have this focus, you've had this historical focus on the lower middle market, and does it still matter today?
Yeah, great question. So it all started when we began to take the business plan that we had written for the firm to some high net worth investors in our network to see if they could help us capitalize the company. And when we went about that process, the feedback that we got was that, another fund of funds focused on buyouts only wasn't necessarily a very compelling strategy, but that finding the kind of next up and coming managers in the buyout space would be much more appealing and attractive. And so we did some empirical evidence research to determine whether or not the small buyout space outperformed the large buyout space. And when we say small buyout, we're generally referring to funds less than $1 billion in size, and then large buyout being greater than $1 billion in size. And ultimately, even though there wasn't a ton of empirical evidence at that time, remember this is 2001, it was still pretty compelling anecdotally, and there was enough empirically that we felt we could make the case. And so ultimately, that's what we decided to do when we launched our first fund of funds back in late 2001.
So you mentioned that at that time, you didn't have empirical evidence. Fast forward 24 years later, what do you have?
So we had some limited empirical evidence back then, enough to make the case, but it wasn't what we have today. And what we have today, just because the databases devoted to private equity have become so much better over time, the evidence is still as compelling as it always has been in terms of the outperformance opportunity that exists in the small buyout space, not only versus the large buyout space, but more consistently better than venture capital and other areas of private equity. What's interesting is the first time that we put together a presentation, we had the famous inverted triangle chart, which shows how much capital is allocated to managers raising more than $1 billion versus managers raising less than $1 billion. And at that time, it was about 65% of the money going to managers raising more than $1 billion and 35% going to managers raising less than $1 billion. Today, that splits about 85% going to managers raising more than $1 billion and only 15% going to managers raising less than $1 billion. So the supply-demand imbalance of capital is still as significant as it was, and even more so. And even though it's more competitive, generally speaking, the managers in the small buyout space really only make about 30% of their return from the impact of leverage. About 70% comes from a combination of both multiple expansion as well as EBITDA growth. And so it's just fundamentally easier to grow a smaller company than it is a larger company. And so even though there is a financial engineering and structuring element to successfully investing in the space, the ability to build a business and do so with the right management team, with the right strategy that you can ultimately execute on successfully, that's what really determines outperformance. And it's just a lot harder to do that in the larger end, where you've got more sophisticated management teams, you've got more complex businesses, and a more competitive environment in terms of the acquisition multiples. So it gets more competitive every year in our space. But the chasm between the large end and the small end, in terms of that competitiveness, that efficiency, still exists as well. So it's still a compelling place to invest.
And so if we look at the space as well, you're also focused on emerging managers. And so, how do you assess these emerging managers on the long term? And when you look at, the top quartile, is there a huge difference between the top quartile emerging managers and the rest?
So it's a little hard sometimes to make the determination with regard to your last question because of the survivorship bias in the data. That said, anecdotally, we believe that it's very much the case that often you can find the most outperformance in the, in a manager's first or second time fund versus, their subsequent funds. It's not always the case, but it's often the case. That said, we've always invested in small and emerging managers, which we define as those funds domiciled in the US or Canada that are taking control-oriented positions in companies, generally speaking, sort of $3 to $10 million in enterprise value, or excuse me, in EBITDA. And so these are managers raising less than $300 million, generally speaking. Up until 2016, 17, we made all of those sorts of allocations from our flagship fund of funds, which we raise every year. But in 2016, 17, we basically decided to take that allocation strategy and put it into its own vehicle, which we call our Small and Emerging Manager Fund program. And it was really important because we wanted to be in more small and emerging managers, because as time goes on, if they succeed and you're not an investor in their fund one or fund two, it's pretty darn difficult to get in their fund three or fund four for the first time. So strategically, it helped kind of shore up one of our flanks by giving us a toehold position in these managers at their earlier stage in life, while at the same time not skewing the risk-adjusted return profile that our clients had come to expect and really want in our flagship fund of funds. So by bifurcating them, it became a better solution for all. So we still do some small and emerging manager commitments out of our flagship fund of funds. The overwhelming majority come out of our small and emerging manager fund.
And so if we continue on your different, verticals or your different way of deploying capital, you also have the co-investment strategy. And so how does that complement the rest, and how do you balance the rest between choosing, let's say, a GP? Do you choose him for the potential co-investment opportunities, or do you choose him for the returns that he's going to bring in on his fund?
So it's a critical question, because we never invest in a fund based on some sort of expectation of co-investment. I could show you a list of, 24 plus managers that we have re-upped with continually because of superior performance, where we've never seen a co-investment opportunity. So any primary commitment we make, whether it's small and emerging manager or our flagship, has to stand on its own as the most compelling return opportunity from a primary basis on a net basis. That said, because we're often one of the top 2 or 3 largest investors in these funds, and our partner, Dave McCoy, who's led our co-investment program since 2010, has just built an extraordinary reputation, not only because of his track record, but because of how easy they are to work with as a partner. We do get to see an extraordinary number of co-investments, about 400 to 500 a year, and we're only doing about 10 to 15. So it's a critical part of our business, because you can generate so much fee efficiency as well as alpha on the co-invest side. Without a really strong primary business, it's our belief that you're not going to have a great co-investment business, right? Because you're not going to see the deal flow, both in terms of quantity and quality. So a very healthy primary business is crucial to a healthy co-investment business.
And so what other systems or processes that you put in place to make sure that, you're consistent within your portfolio balancing?
So we have a repository of small buyout market information and data at the fund level, the firm level, and most importantly, the portfolio company level. So we track actually over 31,000 small buyout fund owned or formerly owned portfolio companies, tracking KPIs on an annualized basis, such as net debt, EBITDA, revenue, purchase price multiples, growth rates, margins, IRR by deal, ROIC by deal, and on and on. So we're able to have an asymmetric information advantage, both on the primary, secondary, and co-investing side. And this is an opaque market that we operate in, right? No small buyout manager is going to give the KPIs, as I just mentioned, on their portfolio companies to a publicly available database like a PitchBook, a Capital IQ, a Preqin. So having that sort of level of information is something that's really important to our comparative advantage, and it allows us to run a very consistent due diligence process. Every year, we run an analysis to determine what are the best performing industry subsectors within private equity in our space, so that we can make sure that from a portfolio construction perspective, we're getting amply exposed, not concentrated, but amply exposed to those spaces. Historically, those have been, generally speaking, technology, healthcare, high margin, high growth, heavily engineered, IP protected industrial, and then lastly, business services. And so when we are constructing a portfolio, we want to make sure that we're amply exposed to those areas, and then we satellite around them. Maybe we do a branded consumer manager here, or energy services and equipment manager here, or a chemicals only manager here. It could be a variety of different approaches. But that is really the core of our portfolio, is exposing ourselves to industry specialists in those four segments. And then listen, one of the hallmarks of the firm has been our team continuity. So we have a process that we continue to seek to improve, and we've certainly added people from the outside from very, very well-regarded organizations. So not everything is homegrown. We brought in best practices from around the industry, but at the end of the day, when you've got that much team continuity, that's going to lead to a very, very consistent process. And that's something that, whether it's a new investment with a manager that we've never invested with in the past, or, it's a re-up, we're going to execute the exact same process to underwrite, whether it's a primary co-investment or a secondary.
If we move on to the last vertical that you focus on, and you just mentioned it, which is secondaries, I believe you pride yourself because more than half of the volume that you do is either through your network of GPs and sellers, or is conducted in partnership with existing managers and LP relationships that you have. I have a question. If you take on a secondary that's highly discounted, where the manager is in trouble, is it possible for you to work in the future with that manager on a primary base, or that's it?
Oh, well, certainly we always keep the door open to every manager that comes to market in the small buyout space, because it's our job to do so. So if a manager doesn't beat their path to our door to raise money, we beat a path to their door. We do not want any single manager in the small buyout space to come to market for a fund and not get a look at it. That said, one of the more interesting sort of approaches we've taken is what we call a Phoenix strategy, where you invest in a manager's fund where maybe they had a great start. Their fund one was good, their fund two was good, their fund three sort of did poorly. Then they made the changes, both the team and strategies, such that they were able to kind of get fund three, out of the doldrums, maybe not into a great spot, but into a better spot. And the, early performance on their fund four, looks very promising because of the changes that they've made, the hard decisions they make. And then they come out for that fund five, and we'll back them, right? We've done that with a number of different folks. Some of those have become some of our best managers. So, it's nice to be able to come in and, not having invested with a manager before, watch them have success, watch them stumble, and then come in for the first time after they've learned those lessons and gain that humility, which, with their backs against the wall, they have no choice but to do everything they can to succeed. And we love the alignment of those interests. That said, we've bought into secondaries where managers' performance has been mixed, but we're loath to do so very often, because manager quality is such an important component of our underwriting on a secondary and co-investment basis that, even at a really great discount, oftentimes we're not comfortable partnering with them. But if their performance has been good but not great, and we only want to partner with great performers, just because you're only good and we come in on a secondary because we got the appropriate transparency and discount to affect a purchase price that made sense for us and could generate the sorts of returns our clients are looking for. But if that manager continues to improve, we'll absolutely back them on a primary basis if they prove themselves worthy. We're not going to staple to a new fund on a blind basis just to win the secondary deal. But we will definitely leave the door open for us to invest with them going forward if they continue to improve.
In this current market, what is what do you seek more? Is it more when you talk about secondaries, is it the equity assets or fund interest at this stage?
Yeah. So basically GP LEDs versus LP LEDs.
Yes, yeah.
We're trying to actually do a relatively even mix between LP-led transactions as well as GP-led transactions. And the GP-led side, it can be multi-asset or single asset. But we started our firm doing nothing but limited partnership unit purchases. And then over time, it's slowly evolved into kind of a 50-50 split between the two.
You closed two of your funds this year. You mentioned the emerging one. The, it's undoubted that the fundraising environment is becoming more competitive and tougher. Uh, in your view, what is the differentiated edge that RCP maintains today?
Well, I think a few things for our own fundraising you're referring to. Is that
Yeah,
correct?
absolutely.
Well, listen, we've been incredibly disciplined about sticking to our knitting in the small company buyout market. So if you look at our first fund of funds, it was a $92 million vehicle. It took us 2 years to raise, and we invested in 14 underlying partnerships. The average size of those 14 underlying partnerships was approximately 450 million. Fast forward to Fund of Funds 19, which we closed earlier this year. That will have 10 underlying managers with a final commitment is on the precipice. And the average fund size amongst those 10 underlying partnerships will be 450 million. So we're generally speaking investing in less funds per fund of funds, but actually maintaining the size of those underlying funds. So when people see a 24-year track record of sticking to your knitting and exercising that sort of discipline, it gives them a great deal of comfort. Also, as a specialist in a market where 9 of those 10 managers that we allocated to for Fund of Funds 19 were oversubscribed. And in the market in general, between 4 and 7 months, the further you are away from the US, the harder it is for you to access that market. So Europe has grown to about 40% of our client base. And Asia / Australia has become about 10%. We expect that to become more significant and ultimately be sort of a third US, a third Europe, a third Asia. And then hopefully we can continue to make some progress in the Middle East. And then we've already gotten a few clients down in Latin America. So I think increasingly you're going to see the US shrink as terms of our LP base, but still be significant and material. But you'll continue to see our international clients make up more and more greater percentage of our assets. And then the ability to custom allocate across our primary fund of funds, secondary fund, or co-investment fund, they all stand alone or separate or equal, allows people, I think, an attractive way to customize and build their own programs in conjunction with us. But for those that are looking for just, simplicity and ease of access, we have our multi-strat fund, right, which is 50% primary, 25% co-investment, 25% secondary. So if you are interested in custom allocating, you can do that. If you're more interested in sort of, a set it and forget it approach, you can do that with us. And neither one is favored over the other, meaning that from an allocation perspective, whatever deal a primary fund is doing, our primary fund of funds is doing, the multi-strat fund gets its pro rata portion of that, right? Same on co-investment, same on secondary. So it's not like multi-strat feeds into our other funds. It invests pari passu pro rata alongside them. So it is, I think, a really good solution. I think our fees, are competitive, but, the most important thing beyond just integrity is track record, right? And benchmarked against very aggressive return targets. I think that helps us stand apart as well. Lastly, listen, I mean, our reputation, I think, amongst the LP community, whether you're an RIA in a family office or you're, a large or small institution, we treat our clients like they are the most important thing because they are. And so we bend over backwards for them. We're incredibly transparent. We're very responsive. And so we try to make the investing experience with us as delightful as possible. And I think that reputation's, helped us raise money as well.
If we move on to, the general private equity market and how it's evolving today, you mentioned that smaller company and the segment where you are, you can grow much easier than structuring financially or leveraging. If you look at the broader private equity industry, are you worried of layers of debt piling on?
So the average debt to equity ratio in a deal in the small company buyout market, so think companies 3 to 25 million of EBITDA, is about 1 to 1. So if you're buying a company on average for 8 times, it's 4 turns of debt, 4 turns of equity. So you can still get yourself into a bad position from a leverage perspective with that sort of debt to equity ratio. But it's a little harder to do that than when you go up market, right? And the leverage ratios look more like 2 to 1, sometimes 3 and 4 to 1. So, when the interest rates rose dramatically, 3 or 4 years ago, it certainly had a negative impact on our market, but it was nowhere near as almost cataclysmic as it was for the larger end. So yes, we've got companies in a portfolio as diversified as ours that are struggling, but you have not seen anywhere near the amount of leverage issues that you've seen in the larger end. So it's a little different because I think with the advent of private credit and its rise and its dominance as the primary provider of debt to our market, these are folks that don't have the same regulations as banks, and they don't have as quick a trigger figure in terms of pulling the plug and putting a loan into workout, and often forcing the sponsor to hand back the keys to the asset, if you will. So I think that helps. We don't have the benefit necessarily of sort of no covenant or covenant light loans to the extent that the larger end does. But again, because we're not aggressively levering these businesses, we're not seeing dramatic changes. Sure, we are seeing some things on the margin, but nothing dramatic, nothing like what we saw in 2009 and 10.
You mentioned the period of high interest rates. Now that it's going down, are there macro shifts or macro trends that you see can be impacting negatively the U.S. economy and the markets that you work into?
Listen, they call economics the dismal science for a reason, right? It's an incredibly difficult thing to predict. And I don't think we're going to have perspectives that you'll find profound versus other economists or managers. But
I don't listen to economists. I prefer to listen to you.
Well, the rise of AI is obviously something that can impact a variety of industries. But software in particular, it's something where we have gotten a little cautious just about how that could impact existing software models. There's also, of course, tariffs, right? And the tariffs and the uncertainty that they brought have definitely negatively impacted the portfolio. And then lastly, and no one ever talks about this, but we've been in basically an industrial recession for the last 2 years. If you look at the PMI over the last 27, 28 months, it's been below 50, like 24, 25 of those months, and that signals recession. The rest of the country and the rest of the industry has not been in recession. And so, because we become more of a services economy and less of a manufacturing economy, it sort of cloaks the fact that the industrial side is weak because the business services and tech side is sort of made up for that and then some. But we saw the same thing happen in 2016 to 18. So I think that right now we're really hoping for a rebound in the industrial segment. We'd really love to see the uncertainty from tariffs be removed, because everyone's biggest complaint in this space, as well as everywhere in private equity, is the amount of distributions, right? If 2021 was the most recent high of distributions, we've been down, significantly from them. Now, we're only down about 30% from the high. If you look at large buyout, they're down like 50 to 60%. Ventures probably down 70+%. Asian private equity's got to be down 80 to 90%. So we, comparatively speaking, look very good, but you're still down 30%, right? And so we have seen in the last, I would say, quarter, a meaningful uptick in distributions. We were just talking about it at our investment committee meeting today, and we're going to do a little bit of analysis to see if our anecdotal observations jibe with the actual, true statistics. But I think we're relatively optimistic that Q3 will end with a nice uptick over Q2, and Q4 could be a more significant uptick. We were hoping for that to be the case for the entire year of 24. We felt like all the elements had aligned to allow us to do so, but then the tariff announcements just really cast a pall over the entire industry, and people were pencils down for a little bit. So those would be kind of just some general thoughts on the economy and where we stand. But it's with obviously job unemployment numbers have gone up recently. We've gotten the most recent uh, cut to interest rates. So I think that can only help spur M&A activity, and that'll help with what has been, a relatively bleak environment there. And it has to happen, right? People have to ultimately capitulate to sell these companies that they bought pre-21 at, arguably in many cases, inflated prices. And they're just going to have to take it on the chin and deal with some multiple contraction in some circumstances because the LPs want the money back.
And if you look at, vintage years and you look at what, you've achieved, uh, are you on par, or is it similar to the rest of the market, or is it differentiated? So what could be a bad vintage year for larger buyout is a good vintage year for you, and vice versa?
And they tend to track together, right? Bad vintage years in the small buyout space and in the large buyout space tend to be, the same. It's just that a bad vintage year for us still generates a much higher top quartile return than it does in the large end, but they're directly correlated.
I'd like to move, to your personal journey and, understand more what drove you to launch RCP Advisors, and, in the early days, what was the hardest part?
Oh, wow. So my career started in the transaction services group at Aon Corporation. And even though I loved private equity as the end user of our consulting services, I really did not like the insurance business. And so when my uncle, who had been a senior executive at Aon, decided to leave to start his own fund of funds on the premise that, there were a lot of folks he knew that were a lot wealthier than he was, but they were allocating to private equity. And so he viewed that there was an opportunity, especially in the RIA market, to distribute a product, and that through our experience collectively at Aon and some of the other folks that co-founded the firm, Charlie Hubner at Heller, Fritz Sauter at Marsh, that we would be able to successfully invest the capital. So what was incredibly difficult was gaining the faith and confidence of investors. You're a first-time fund. For the most part, we hadn't worked together. We had no anchor investor. We didn't have a portable track record, and we incorporated 3 days after 9/11. So, as I like to joke, with the exception of our wives, most everybody thought we were destined to fail, and I'm sure our wives had their doubts as well. But ultimately, what took place was the benefit of just such complementary skill sets, and the fact that we were all in. We jumped into the deep end of the pool, and it was either make or break for us. And so I think we had a marketing ethic that a lot of other investment firms lack. You can be too heavy on the marketing side, but I don't think we were guilty of that. And we really just were persistent as hell. And we kept doing what we said we would do, and hitting every milestone. And so that's what won over investors' confidence, in the beginning, but it took a while. So I'd have to credit it to all those things, but without a doubt, the raising the money was the hardest part.
Was there another pivotal moment or a point in time that was key to shape the firm's trajectory?
Yeah, I think a few things. So, as time wore on, we became increasingly institutional in our investor base. And I think by fund of funds 4, we were sort of 50-50. Today, it's 60% institutional, 40% high net worth, including family offices. And so I think once we gained that traction institutionally with Fund 4, that really helped power our growth. But then again, in 2008, we raised our 6th fund of funds, and it was smaller than our 5th. And that was obviously due to, the global financial crisis erupting. And so we were really disappointed, but it didn't take a genius at that time to know that the most compelling investment opportunity were secondaries. The problem was we had never actually invested, we'd only done one secondary as a team in our relatively brief history. But we had the relationships advantage, we had the market intelligence advantage, we had the data advantage. And so we were able to convince enough LPs, both new and existing, to support us in raising our first secondary fund back in 2009. That was a crucial component to our growth. And then we started co-investing out of our fund of funds, Fund 4, but a very limited amount, 5% of committed capital. But by the time 2010 and 11 had rolled around, we had a portfolio, all of whom at the time were doing relatively well. One has since not done well. And so with that relatively nascent track record, we were able to do two things. Number one, launch a standalone co-investment fund, but also bring on board a portfolio manager for that, guy by the name of Dave McCoy, who's really become the de facto leader of our firm. And so getting into the co-investment business was incredibly important. So each step along the way, getting more institutional, getting the secondary business, getting into the co-investment business, ultimately getting into the advisory business with a separate account, and then getting into the small and emerging manager business most recently in 2017. All those were fundamental steps to continue to grow our business, take advantage of the comparative advantages we had, stay disciplined in terms of focusing only in on the small buyout space, but just attacking it from a variety of different vantage points that allowed us to, diversify the business, and that's been key to, our sustained success.
And so, it's very clear of what you're saying, that, you will keep on looking at potential growth opportunities and how to get to the next stage. And so how does getting institutional investors change, the management itself of the company, or you were already ready to welcome institutional investors?
We were already ready to handle institutional investors, but what it does is provide you more credibility with the market. Once you have a lot that will serve as references and that have had a good experience, it just attracts more, right? And bigger check sizes allow you to grow the business, but of course you don't want the check sizes to grow to the point where it forces you out of your area of focus, your reason for being. If we were trying to provide someone a venture capital fund of funds, or providing someone global exposure to private equity, we would be a terrible choice versus the Adam Streets and the Pantheons and the Harbor Vests of the world. But when it comes to this specific segment, small buyout, I think we can make a very strong argument that those same folks can't do it anywhere near as well as we do. So staying focused where we have, but being able to grow around it has been key. And without the institutional investor support, I don't think we could have accomplished that.
And if we take throughout your career, what do you think are the core values that made the difference?
I think number one, integrity. We have always done the right thing by our investors and put them first. We're great partners with the underlying managers, as well as the co-investments we do with them. So I think integrity is number one. I think number two is humility. If you look at what tends to damage a private equity firm's track record and ability to continue, hubris, in our experience, is almost always the number one reason. So when you're witness to that, it allows you to realize that that's something we don't want to do to ourselves, because it's self-destruction. It's avoidable, right? Sometimes bad luck happens, right? Sometimes you make mistakes despite despite best efforts. But to knowingly self-destruct because you let your ego get in the way of what was best for generating returns and for serving your customers, that just seems like a terribly unnecessary thing to suffer. So I think humility is number two. And I think three is just, our constant striving to improve, whether that's improve our fundraising, improve our investing process, improve our reporting, our culture. Our culture at our firm took a real hit in COVID. And so we started institutionalizing quarterly town halls. We do an NPS score every quarter from the employees to determine how we're doing. We hired an extraordinary head of HR. And a lot of other initiatives were put in place to try and bring that culture, which had been our strength, and all of a sudden had turned into a weakness because of the whole out of office sort of policy and frankly, us not paying enough attention to it. So I'm glad to say that our NPS score is well above average and into the excellent category as judged by our employees. So I think, striving to improve in everything we do, never kind of resting on our laurels is probably the other reason we've been able to continue to succeed.
Beyond the private equity, I know you have interest in education and as well as, the healthcare. How do you approach that? Do you approach it in the same way that you approach your business, or is it a totally different way?
Well, I think the best thing that we can do in one is to, try to generously, give from a capital perspective, right? From a dollar donation perspective on the healthcare side, because I don't bring any real healthcare industry knowledge of any significance. And then on the education side, it's more career, right? Taking the Evans scholars that, get the scholarship and then ultimately, are able to matriculate from university and then find their way into the workforce, whenever an Evans scholar reaches out, to me blind, cold in an email, I always take the meeting. And then always do my best to try and be helpful in networking them around or positioning them in the queue for an interview if we have a position that's open that might fit their background, experience, skill set, what have you. So yeah, I mean, one is much more financial. The other one is financial, but more time and trying to make active efforts to be directly helpful.
We took a lot of your time today, and I appreciate it. A final question. You mentioned that when you launched, not all the team had worked together, and you were starting. If we take the same qualifications for an emerging manager that comes to you, can you or would you invest in him?
Very unlikely. And I realize how unbelievably hypocritical that is. But, team stability, especially an emerging manager, is an incredibly important component in terms of the risk that you're underwriting. You're also taking even more significant key man risk almost always in a small and emerging manager fund than you are in a fund that's more established. And so you also want attribution for the track record. So we're almost never going to back a firm where you've got private equity person A and investment banking person B, and they went to business school together, they grew up together, and they decided to join forces and hang out a shingle, right? That's just not what we do. The managers that we back are oftentimes independent sponsors that have been working with each other for 5, 10, 15 years, have finally built a track record and a differentiated strategy that allows us to underwrite it, that is fully attributable to them, that we can then, gain comfort that they have a team, process, and strategy that ultimately is going to deliver the performance we're looking for. However, you also get managers that spin out of existing firms, right? Somebody goes from a $300 million manager, then 15 years later, or 10 years later, they're at $1.5 billion or $2 billion or $3 billion, and there's some folks at that organization that will say, listen, it's been a great run, but we would rather be doing the small deals. We find that market more interesting. It's more relationship driven. There's more return potential. So we're going to spin out. And sometimes that spin out's done acrimoniously. Sometimes that spin out is done with the blessing of the firm and the partners that they're departing from. But either way, we seek to underwrite those folks. And again, you've got a team that's worked together. You've got a strategy that's attributable to them. That we can then underwrite. So very rarely would we, almost never will we back somebody that looked like us, which I realize is terribly hypocritical, but is also the truth.
The world has changed as well, so we have to face it.
That's
Absolutely.
true. That's
Absolutely.
true.
Tom, thank you so much for your time.
No, it's a real pleasure, privilege to have the opportunity. So thank you very much.
Thank you. Thank you.